Okay, so we are now starting our options KB. So now let's just, before I start our options, okay guys, they're still talking here. I'm still hearing voices. Okay, before we start on, so we are going to start our conceptual framework for equity option trading. Again, this module has been front-ended. This should actually have been at the last, in the last part of the course. This has been front-ended because you have to do your project. So I have to give you some, I mean, even with this, you'll feel that you're not adequately equipped knowledge-wise to do your option trading. But that's just something we can't help because of the scheduling of the course. But even then, you'll get a feel for option trading and what is involved, the complexity of the business. So what we are doing is we are actually front-ending this. In what sense? This is what I mean by front-ending. Okay, if we look at this framework, to make it much smaller. Okay, I think you can see options. So we can't see it fully, but you can see that's the last column. Okay, so in this framework, what we would have ideally done is, when we were starting the study of derivative products, we would have started with futures and forwards. You've already done a little bit about futures. You know how futures settle. You know the daily mark-to-market mechanism of futures contracts that we studied. Okay, so that is an essential feature of all exchange-traded markets. That is why you notice that futures are written as exchange-traded markets. Okay, so there is no, you will never find futures as an OTC product. It's always exchange-traded. All right. So we would have ideally started with futures and forwards, which are very, very similar products. There's some cash flow differences, and then we would have gone on to swaps, and then finally we would have covered options, ideally. Okay, because options are the most complex instrument type, but we don't have the luxury of that because we are doing this project, so we are front-ending the option module. All right. Now, just a little bit briefly on options. So this entire thing is there in your folder, in the equity option trading. This one. In this folder, you'll find this entire KB, so you don't have to write anything. So once again, remember, let me reiterate, is that all we can have? 100? We can actually maybe do even better than this. Yeah, you guys can you guys read input parameters on the last bench? Yes. You can read input parameters used to price an option. You can read this stuff. Okay, so this is okay. So that means we can have maybe even bigger, make it 125. Okay, I know why this is happening, because I reduced the zoom on the browser overall. That's why we suddenly have this change. Okay, right. So we have this. This is your note, and this is where your readings are. Okay, so start doing the readings in this sequence. Okay, start doing the readings from your textbook, Halbasu. And these are your links. I'll put the links randomly into this. And this is our asset classes market. So here in the introduction, okay. So options are what? A derivative instrument or a underlying instrument? Derivatives. Okay. So there is one exception to that, and that is you should be aware of that. We are not going to cover it. It's not a very. So let's write it this way: add options are always derivative products or derivative instruments. Okay. Exception is something called a compound option. Okay, you will find this in that book which I've written. You will find, if you want to learn about compound options, you will see a discussion of compound options. Compound options is where you have options. You have call options on call options, call options and put options. Okay, so these are options on options. These are not standard products, so they don't trade actively, but the product does exist. I mean, it existed as far back as 1993. So and they still exist. So therefore, you should be aware of this exception also. So options in general are always derivative instrument, except for compound options, where one of the where the underlying instrument is also underlying asset is also an option. Okay, so you can have a call on a call, call on a put. Okay, put on a call, put on a put, all these kinds of combinations. So you can read up on compound options. I'll just put the mnemonic here. So you can read up in that booklet, Risk Management Solutions. Okay, so options are always derivative instruments. Now, here we have to put in one more exception. There are some limitations in this framework because I'm not drawing freehand, I'm constrained by the Excel formatting and all that. So now there are certain types of various, you can have options on. So the first thing to understand about options is, options are derivative instruments, okay? So what is the characteristic of a derivative instrument? I don't know if we've discussed this before. What is it? Let's first understand the very basic concept of an option, which is, what is a derivative instrument? We'll just use the word derivative product because it's shorter, okay? So what is a derivative instrument? How will we define that? Guys, Mike, pass the mic. Who's going to answer that? Is the question clear? How should we, because everything that you study, you should be clear about what the definition is, right? The definition makes a very big difference to your conceptual clarity. You should be able to understand that, you should be able to have the definition clearly in your head. What is this, okay? What is a derivative product? Okay, so how should we define a derivative product? Anybody? Yes? I hear somebody whispering. Anybody? Who? Who is Saksham? Okay. Anybody wants to answer derivative product? Okay. Yes. Use the mic.
Derivative products derive their value from the underlying assets.
Okay. Okay. Good. So value. So I'm just writing. We're not writing a very proper full English sentence, but value is derived from an underlying asset. Okay. That's why you say that. That's why you use the word derivative. Okay. So the value is derived from an underlying asset. Strictly speaking, to make this, so you can see here that you can see here what the underlying markets are and the derivative markets are. Cash and spot are the underlying in this framework. But because of the limitations, now we'll come to that. But first, let's just get the derivative definition clear. So the derivative instrument is one whose value is derived from an underlying asset. Normally, that's the definition you'll see in most of the books. But actually, this definition needs to be made a little bit more watertight, because this is strictly speaking not correct. What we should actually say is, the value is derived inter alia Now, you know this expression inter alia, you know what it means? Who knows? Who remembers? Among other things. Very good. Okay. So, among other things, you would have covered this while doing lab. But it's a very useful expression. Okay. Whenever you talk, try to make use of inter alia wherever you can, because it will give you flexibility. Okay. So that later on you can add other stuff. Okay. So why do I write it like this instead of just saying the value is derived from an underlying asset? Because when you look at the formula for pricing derivative products, you will find that it's not that the underlying value of the underlying asset alone makes up the value of the, contributes to the value of the derivative product. There are other variables also that contribute, like interest rates, volatilities, etc. Okay, so that's why I use the word inter alia. Okay, and what we say is that it derives principally from the value is derived inter alia principally. Let's make it a little bit better, from the value of an underlying asset. Is this clear? So now we have a slightly more legalistic definition. Okay, it is always important to have legalistic definitions because it clears your mind. You know exactly why you're writing this kind of thing, because it gives you a better picture of the reality. Okay, so the value of a derivative instrument is derived inter alia principally from the value of an underlying asset. Okay, so and the reason I put inter alia is because there are other factors like interest rates, volatilities, etc., which go into the dividends. So all of these are actually factors also in a, and if you change any of these other factors also, the non-principal factors, okay, even if you change the values of those, the value of the derivative product will change. So it is strictly speaking from a legalistic point of view not correct to say just that the derivative is one whose value is derived from an underlying asset, because that would give the impression that only the underlying asset contributes to the value. Is this clear? Again, we are speaking in long English sentences, but this is what you have to get used to. Comprehension has to be improved, because otherwise you're not actually speaking correctly. This is clear? Satyam is already falling asleep. Okay, good. So why don't you guys come to the front? Let's stack the front benches. Who's going to come to the front bench? Let's bring, we can bring some of these people here. Let's bring Ishan and Bhola come to the front. And no, you're happy, but I'm not happy. You come, Bhola can come and sit next to Chadda. You'll be happier. It's his birthday, so you can wish him. And he'll be happy and you'll also be happy. So Ishan can come and sit next to Bell. And then you guys, Tushar can come here. Tushar and Satyam come. Somebody sit next to Akanksha. And then let's bring who else? Let's bring Nimish and all into Shivani's row. So let's stack the front benches. And Keshav can also come somewhere. Keshav can, Sushant can move in and Keshav can come here. You guys come here. Somebody sit next to Akanksha. This chair is a problem. Okay. So let's have stacking of the front benches. What happened to next to Akanksha? Seat is broken.
Yes, it's broken.
Okay. All right. Okay. Fine. Okay. So what were we saying? So I just want to make sure that people are properly, properly awake, because the moment I go into a long sentence, everybody seems to be dozing off. So it is important to write derivative like this. Okay. So the or let's call it the instruments which form the underlying asset for options can be. Is my question clear? Now we are asking this question of, since we are saying that options are derivative products, and this expression underlying markets and derivative markets, these expressions are used in tandem. Okay, so we talk about underlying markets versus derivative markets. Sometimes we also say, as you do a mouse over here, sometimes we also use this expression cash markets. Okay, so when we are talking about derivative markets, we are talking about cash markets. So this is why I say that finance is much more like law than like physics, because all the terms, you'll see the same term being used in a different kind of context, just has a slightly different meaning. Okay, so when we use the word cash markets in conjunction with derivative markets, it's not the same as the cash instrument. Are you following? So why you have to be very sensitive to the context to understand terms that are used in finance. These are all mainstream terms that are used in industry. Okay, so people will talk about cash markets versus derivative markets. But when they are using that expression cash markets in that context, that cash market could be referring to the spot market also. Okay, because here cash markets is not only just cash instrument. Okay, as a settlement date and transaction date is the same. Okay, it's not this. So you have to be aware of the context all the time. Okay, so my question is, so we know that these are underlying markets and these are derivative markets. So this actually labeling is not 100% correct because of the formatting restrictions of Excel. Now we will remedy that deficiency. What we are going to do is, we are going to clarify. So we know one thing, we know that options are derivative products. Okay, we know that options are derivative products. And so every derivative product must have an underlying asset. Okay, so one of the questions that is that one should be clear about is which instruments can form the underlying asset for an option. Is my question clear?
Yes, sir.
Since we are saying an option is a derivative instrument, what types of instruments can form the underlying asset for a option contract? Okay, yes?
Common stocks.
Yeah, common stocks. So what we are talking about is instruments now. Okay, so common stocks, yes. So what type of common stocks, when you're talking typically about common stocks globally, where would it go in terms of instrument? Would it be in cash, futures, spot, forwards?
Yeah,
Where?
for spot.
Yeah, it is actually spot. Okay, most equities globally will trade spot equities. When you're talking about common stocks, most world markets will trade on a spot basis. Now that spot may be T+2, it may be T+3, and here in India now we are trying to move to T+1. Okay, so there might be a variation between T+1 to T+3, but it's centered around T+2. So that's why we say spot is T+2. Okay, so typically, so what we are saying, one of the things that he's saying is one of the types of instruments will be spot. Okay, Is this clear what we are listing out here? What are the types of instruments that can form the underlying assets for an option contract? Okay, so first is spot. Okay, anything else can we add? I just gave you some information about a exotic product based on which you should be able to give me one answer at least here. Options, right? Who said that? Okay, good. So options in the case of compound option. Okay, remember that option itself can be a underlying instrument for an option contract. This is quite rare, but this is in the case of a compound option. So we can write this compound options as a rare example, but it is possible. Okay, we should be aware of it. Now, so what else? Can we have anything else? I have also mentioned, I've shown you certain data feeds on the TWS. I have looked at crude oil options. I've experimented with crude oil options in the class. So what were the underlying instruments for those options? Commodities are not an instrument. Commodities are an asset class. What kind of instrument was a? Yes, futures, right? So you remember that this is also a very important type of option. A very important type of thing is futures. Okay. So futures can also be a very important underlying instrument for options. Okay. So many of these options, crude oil options, for instance, will principally trade as futures. These instruments are called futures options. So let's put in the term here as well. So whenever you hear futures options, in fact, when you're setting up your data feed in TWS, you might actually get this option as well. Okay, when you're setting up an option, you might get a feed option of, they may ask you, do you want futures options? Okay, and that is typically written as FUT OPT. Okay, that's called a futures options. Which is futures option means the option is an option on a futures contract. Okay, so that's an option to buy or sell a futures contract. Okay, unlike the common example of equity options which you will be trading, those are on spot. Those are options on spot. Okay, but you should be aware that you can also have futures options. In fact, most of the commodity options are futures options. Most of the exchange traded, if you notice here, that under currencies, well, not just, I couldn't make a separate classification for that. You notice that under on top of options, I've given both exchange traded and OTC, because options trade in both OTC and exchange traded markets. Okay, so for instance, the main foreign exchange options market is actually an OTC market. Okay, but there are also options on currency futures. Okay, so those are futures options. So ideally what I would do is, I don't have the formatting skills for that. I don't even know if it's possible. Ideally, I would shade half of this box green and half of it blue. Because you can have options on currencies, you can have them trading either as futures options, okay, in which case they are exchange traded, and you can also have them trading as OTC FX options, in which case they are OTC market instruments. Okay, so the bulk of FX option trading is OTC, but there is also a significant volume on the CME, and maybe some other exchanges also have set up now, but CME was the main venue for futures options on currencies. Okay, so pretty much every instrument, pretty much every market on which there is a futures contract, you will also have a futures option. Okay, pretty much, maybe not for all of them, but most of them will have that. So this is something else to be aware of. Okay, you can also have forwards. Let's call this futures options. You can also have options on forwards. Okay, so your OTC FX options are actually options on forwards. Okay, so that's another type of underlying instrument that you have. So you can have forwards, and you can also have do you see something else here? Another type of instruments, under interest rates. You can't see the left hand side here. Under debt. Okay, under debt, under options, I've listed various types of options. All these products you can read up in that book. risk management. So if you want, this is not part of your syllabus. We won't have time to cover all these in the class. But if you want to read up on all this is covered in that interest rate, under the interest rate risk management chapter. Okay, if you want to read up on all these products, interest rate IRGs or interest rate guarantees, caps, floors, okay, collars, corridors, all kinds of stuff. Okay, you can read out. These are all interest rate options. Those are interest rate collars, corridors. There's also something called a swaption. Okay, that is also listed under debt, at the intersection of debt and options. Okay, a swaption is actually an option on a swap. Okay, so what we should do now is we should take this also. So what we are saying is, out of the types of instruments, pretty much every type of instrument can form an underlying instrument for an option contract. Is this clear? Even swaps. So you're not clear about this last part. So even a swap, you have not really seen, you've already seen some examples. Remember when we discussed those swap driven issuance transactions? What were they doing? We discussed 5 types of capital market swaps. Single currency interest rate single currency fixed floating interest rate swaps, single currency basis swaps, both legs floating, one currency. If you remember all this. Now let's, you guys have already forgotten because you guys are not revising. This will be under TED. Didn't we just cover the whole category of capital market swap? It's a very important type of instruments. Very important type of instrument. So we have already covered in this framework. Swaps, we have already covered most of one part of it. We did not have a chance to cover FX swaps. Okay, but we have already covered we have already covered IRS and currency swaps. Okay, what the market calls IRS and currency swaps, which we have classified in this manner, which is this manner. We classified in this manner. So these are all what the market will refer to as swaps. And the FX swaps, the market will refer to as FX swaps. Okay, that's why you notice how important it is to be very, very particular about the terminology, because the market will use some particular terminology, and sometimes you have problems because, like what I've taught you in this particular, what is happening with this constant sound of somebody talking. Okay, now you have to be very, very particular about the use of terms in the market. You have to be aware of what term the market is using for what instrument. And sometimes, like in the case of these capital market swaps, where I've also given you what I think is a better theoretical taxonomy. So you have to then understand the taxonomy at 2 levels. One is what is theoretically correct, and one is what the market is using. Okay, that is required. So therefore it's very complicated. So you guys have to revise all this stuff, because you're hearing all these instruments, you're hearing all these names for the first time. If you don't revise, you will not be, and once you revise it and understand the concept, you'll never forget it in your life. Okay, but you need to put in that effort. So now, are you clearer what I mean? One type of swap is a capital market swap, which the market categorizes into interest rate swaps and currency swaps. Okay, IRS and currency swaps. And so these we have seen. Now these are also instruments, okay, which you can transact in. Okay, you saw that company XYZ Corp was doing a cross currency IRS with Standard Chartered. Okay, so that's an instrument. Okay, now that type of instrument can also form an underlying instrument for a option contract, and that would be called a swaption. Okay, those are called swaptions. There also you can read up in that book itself, you'll find the discussion of swaptions, payer swaptions, receiver swaptions, okay, all kinds of swaptions. So pretty much all type of instruments is every type of instrument is, no, this is still forwards, so we should call it swaptions. Okay, all right, so when you have an option on a swap, that's called a swaption. Okay, here the swap is referring to the capital market type of swap. Okay, interest rate swaps and currency swaps, and it is not referring to foreign exchange swaps. So you see how complex market terminology is and how careful you have to be, because normally what do we say? Normally when we are looking at when we initially just started broadly discussing the asset classes, this particular framework, we often refer to currency markets as foreign exchange markets, don't we? We refer to currency markets as foreign exchange markets. We say FX markets. Okay, so in general, so you have to be very, very careful. That's why I'm saying that. That's why I always say finance is much more like law. that you'll be very careful about what context is, what is the context when you're using terms. So normally when you're referring to currency markets, you can talk about, you can say FX markets, foreign exchange markets, okay? But when you're talking about swaps, you have to be very careful, because an FX swap or a foreign exchange swap, which is a term that the market will use for a different, and now that is different from what you studied here. These are what I have called capital market swaps, okay? That's not a market terminology, but I needed to create a difference between FX swaps and swaps, okay? Because that taxonomy is not proper. If you can't call one category, you can't call these things swaps. You have to call them capital market swaps, so that FX swaps is different. Because if you call them swaps, then FX swaps will have to have the properties of these swaps, okay? So you understand the taxonomy problem, right? If I say all students, okay, all students must be carrying a ruler. If you're not carrying a ruler, you're not a student, okay? Then if I make a subcategory of BCA student, then I can say the BCA student is carrying a ruler. Obviously he has to carry a ruler because he's a student. And on top of that, he carries a calculator. Now I can define a BCA student like that, okay? Then I can say MBA, PGDM student is also carrying a copy of Economic Times. So therefore PGDM student must also be carrying a ruler because he's a student. You understand what I'm saying? You understand how taxonomy has to be very, very particular. So the moment you define a PGDM student as a species of student, and you have said that what is the characteristic of a student is a person who's carrying a ruler. So that means PGDM student, if you say that fellow has to carry a ruler, and on top of that you have given him another property that he carries a copy of Economic Times. Are you following? So that's why we can't have a taxonomy which the market uses. The market says these things actually are swaps, and there's another type of instrument which you have not yet studied, which is a foreign exchange swap. That's not proper, because the foreign exchange swap has very little similarity to this instrument. Are you following? So it's like saying that student is somebody who always carries a ruler, but PGDM students don't carry any rulers. Are you following the problem? It's a little complicated, but it's important for you to understand these terms, this kind of logic. That's why we had a brief discussion on logic. This is where you get conceptual clarity. This is part of how you get. Are you following the problem? If I say that a student is somebody who has to always be carrying a ruler, then I define a PGDM student as somebody who's carrying only Economic Times but no ruler. Then how can he be a student? If he's not carrying a ruler, he can't be a student. So if you define a subcategory, so that must have all the characteristics of the general, the higher level category. So if you're a PGDM student or a BCA student or an LLB student, you have to be carrying a ruler. On top of that, LLB student will carry a copy of the Contract Act. You can say that, that's okay. But then you can't have a subcategory of student who will not be carrying a ruler. Are you following? Is this clear? Tushar is confused. How is it confusing? No, I can't accept confusion on that. I'll explain it 15 times if required, but everyone must be clear about this. That if we have, this is very important, otherwise you will not have conceptual clarity of this kind of basic, this is like set theory, okay? This is like set theory. So now, so you have these kinds of categorize, that's why I keep on using this expression, contract is a species of agreement. I keep on rehashing the same thing because I want to make sure people have understood. So let's see, very clear. A student is somebody who has to be carrying a ruler, okay? Now LLB student will carry a copy of the Contract Act, okay? But he has to have it because he's a student, so he has to have a ruler. In addition to the ruler, he must have a copy of the Contract Act. PGDM student will have a copy of the Economic Times, and BCA student will have a calculator, okay? But all these three categories, because they are all categories of student, they must carry a ruler also, okay? So now what happened, this is all I'm saying. Now what I'm saying is that the market terminology, whereby the market has this kind of, see, the market calls these things swaps, okay? Let me put it here, which I'm saying is not correct, okay? The market calls these things swaps, and then the market defines another category, which is FX swaps, which is very different from these instruments, okay? So therefore you can't call these FX swaps, because the moment you call these FX swaps, this must have all the characteristics of swaps. Okay, are you following?
Yes.
Okay, see, make sure that everybody has understood this. Namita, have you followed this logic? No. What are you doing? You are busy exchanging something with Sandhya. Has Sandhya understood this? You understood? Okay, good. So please, so that's why I'm saying, so you have to understand my logic also, you should be able to explain it to others. Because in the market, the terminology is when they are referring to these types of instruments here, they will call them swaps. And when they are referring to another type of instrument which you have not seen, okay, that is called an FX swap, okay. You have actually seen the structure of this, that is, it's just nothing like but a intra-market spread, okay. It's an intra-market spread, it's just like a repo. It's exactly the same structure as a repo, but we have not covered the instrument individually. But the point is, it's very different in structure from this. So therefore, you can't start defining now a PGDM student as somebody with no ruler. Then you can't call him a PGDM student. Are you following? Everyone is clear about this?
Yes.
Ayush?
Yes, sir.
Okay. Okay, good. So this is what I'm saying. So that's why I'm saying you have to be very particular about the terminology. You learn the terminology where there are conceptual problems in the way the market applies terminology, and there are many of them, because the market does not think like an academic and what should be the proper categorization logically. They don't have time for all this, because there are opportunities coming. They need to come out with new products and seize the opportunity. So the market comes out with terminology without thinking about it too much. That's why you have stupid terminology like CDS. Credit default swap has nothing to do with a swap. It's actually like a barrier option. Okay. So therefore, so you have, but still you can't tell the market what to do. Okay, whatever the market terminology is, you have to learn that terminology. But you should also be clear in your head as to why this is not conceptually correct. Okay, so that as an MBA student, you must have that clarity. Okay, all right. So what were we saying? Swaptions. Okay, so when the market talks about swaptions, it is referring to what I have called capital market swaps as the underlying instrument. Okay, or the market calls. So the market will just say swaptions are options on swaps. Okay, so what you have learned now is in the introduction to options is the proper definition of a derivative instrument. Okay, and what are the types of underlying okay, it could be underlying asset. For options can be, all these can be accepted. All right, okay. So, right, now we are ready to move on to the next module in this. Okay, so far everyone is clear? Okay, now we have to look at, now we should do this exercise as an exercise, okay, without showing you the answers. Let's have some really big font size here. Okay, now tell me, when you are specifying an option, okay, when you are like, when you go, if you go to a car dealer and just say I want to buy a car, does he have clarity now?
No, sir.
Because you need to tell him what four-wheel drive, sedan, or what you want to buy, what Hyundai or whatever Toyota, or whatever you want to buy. Okay, what should be the engine power and what horsepower and this and that. Okay, what should be the features? So you don't know. You need to specify a lot of things in order for the car dealer to be clear as to what you want. Okay, so similarly, when you're going to an option dealer and asking for a price for an option, okay, what are the things that you have to specify? Okay, you don't need to take notes, this is all written in your notes, but I will, maybe I should just move the notes so that nobody, okay, we'll just see, it doesn't matter. All right. Okay, tell me, is my question clear? If you want to buy an option, okay, if you just say to the dealer, I want to buy an option, okay, give me a price, I want to buy an option, okay, or I want a price for an option, okay, give me both bid and offer, okay, that's obviously not sufficient for him, because he needs to have more clarity about what actually do you want, okay, so yes,
Sir, date.
one by one, yes, Tushar, give him the mic.
Sir, date, firstly the date of which month or
Date of what?
expiry. Expiry.
Who said expiry? Okay. So expiration date is one factor. Okay. So you need to now somebody has opened this. Ishan has opened the spreadsheet. Okay, fine, no problem. You can open the spreadsheet, but it's much bigger over here than on your phone. Okay. So one is the expiry date. All right. One is the expiry date. That's clear. Okay. So now you have some clarity when you set up your options. When you set up the option trader in TWS, you can see that there are various expiries for which options are trading. The same option is trading for various expiries. So that's one thing that you have to clarify to the dealer, that I want an option for 3-month expiry. Okay, that's one. Anything else?
Buy or sell.
1 minute. No, premium is something that he's going to quote you. The premium is just the price of the option. Okay, so premium is, you can remember it from insurance premium as well. Insurance contracts are also option contracts. You've studied insurance?
Yes.
You did a course on insurance?
Yes.
Okay, so insurance is also like an option contract. Okay, I pay a premium to take fire insurance on my house, on my home, and then if my home burns down, then I will exercise that option and ask the insurance company for compensation. So the money I pay for the price of the option, as a price of the option, is the premium. Okay, so even in the financial markets, we use the same terminology. Option price is the premium. Okay. All right. So premium is something that will be provided by the dealer. Here we are talking about what are the things that you need to clarify to the dealer. Asset class. Well, is it asset class really? Is that sufficient? You have to actually specify the market instrument combination. Okay, you have to specify the market instrument combination, which is the underlying asset for that particular thing. Asset class is, because asset class is very broad. If you just say I want a foreign exchange option, there are so many foreign exchange markets, right? So that's not sufficient. Asset class is not. So you have to really specify what is called the market instrument combination. Okay. Maybe this should be small. You understand what I mean by market instrument combination? Okay. Because every market is always trading in some kind of instrument or the other. So if you want, for instance, if you want a currency, if you want an option on a currency futures contract, okay, let's say you have the Australian dollar futures contract and you want an option on the Australian dollar futures contract. Now that is different from wanting an option on OTC FX option on Australian dollars, which is actually an option on a forward. Okay, so because these are all European style options. So these are two different things, although everything is the same. Asset class obviously is the same, the market is the same, it's Australian dollars, okay, but the instrument is not the same. Are you following now?
Yes.
The market is, we say Aussie dollar against US dollar is the market, okay, but that market can trade in various, in the form of various instruments. It can trade as a spot market, same thing, Aussie dollars, US dollars. It can trade as a futures contract, it can trade as a forward contract, okay. So therefore the market remains the same, but the instrument is changing. So that's why I say that you have to specify, and obviously if a dealer is giving you an option price where the underlying is an Australian dollar FX futures contract, that's a different option price from if he's giving you an option on a forward contract. Okay, so therefore you have to specify what is called the market instrument combination. Okay, because every market is always trading in some instrument or the other, in the form of some instrument or the other, but the dealer, because there are so many possible instruments, okay, the dealer offhand will not know what instrument you are thinking of. This is clear? All right, so that's why you have to specify the market instrument combination. Asset class is not sufficient, that's too broad. Okay, currencies, Australian dollar is a part of an asset class, but everything else is, so many other currency combinations are in that. Okay, is this clear, everyone? Okay, so you have to clarify the market instrument combination. Okay, what else?
Call or put.
Call or put, very good. Whether you want a price on a call or a put, okay. Anything else? You've done options, haven't you, in FM1, FM2?
No. Yes.
You've done some, right? So I think you've done some basic stuff. Did you do intrinsic value, time value?
Yes.
You did all this? Time value, intrinsic value has been done? Now you forgot it. So, okay, call, put, anything else? Wise, what else? Anything else?
Spread.
Yes?
Calculation by using spread, like butterfly.
No, those are strategies. Butterfly spreads and all those are option strategies. We haven't even reached there yet. We are now talking about very basic stuff. Like you want to, okay, you came into the showroom and you want to buy a TV. Now as a salesman, I'm confused. What you want, LCD, LED? Which brand do you want? What should be the screen size? How many ports should be there in the TV? All these things you have to clarify. Otherwise, how will I give you the price? Okay. So similarly, you have to clarify many things. What else? Anything else, guys? Can we quickly speed it up? Have you heard of something called strike price?
Yes, sir.
Or exercise price?
Yes, sir.
What is that? At which? The trade, yeah. And when you exercise the option that you buy the underlying, buy or sell the underlying asset at the exercise price or the strike price. Okay. So therefore, you have to mention exercise stroke strike price. No, market order here we are just asking for. Market order is an order that's in a kind of a quote driven market. Here you're asking a dealer for a price. Okay, you're not placing an order. Okay, you are talking about. We are just trying to understand the various aspects that need to be clarified in order for the dealer to be able to give you a price. Okay, so exercise price and strike price has to be covered. Okay, anything else can you think of? Margin.
That will be provided by the
Yeah, margin and all is that depends on where you are in OTC or exchange trading. Okay, did you guys, when you did FM1, FM2, did you do different styles of exercise? American style, European style?
Yes, sir.
Yes, sir.
So you've done it. Some people remember.
Graduation. Then graduation, not in.
Not in FM1, FM2. Exercise style is also important. Okay. Yes. What? Exercise style. Okay. So now let's go to your notes and see. So these are the 5 items that you'll have to specify to your dealer. Okay. And then there are some other points also that need to be fed into the option valuation model. Okay. Yes.
The European and American.
European, American, and there's a third type, which is what lies between Europe and America? No, there's something in the ocean. There's anything that any particular part, any particular country are reminded of if I use the word triangle? Bermuda, okay? So there is something called a Bermudan option also, okay? So we have to see that. So we'll see, now this is just for your testing. Okay, so let's look at this now. Okay, so you have call, put, these are the things that we looked at. Okay, we have to really say, here we have to say market instrument combination. So let's just copy it from there. Underlying asset is a term that we are using for all right, for relative to the derivative product, what is the underlying asset? Okay, but here to be very specific, what you have to be looking for is what you have to specify is the market instrument combination. Okay, that I want an option on Aussie US FX forward. Okay, 6-month FX forward. Okay, that's how the specification has to be described. Okay, okay. So these are the things that you have to now exercise style. You guys are learning. Some of you. Okay, let's assume you didn't do it in FM1, FM2. So read the 3 styles. While I rest my voice, please read the 3 styles. And then read the other 3 also, 6, 7, and 8. Yes.
What's NN?
Who is sleeping? So since Bermuda is halfway between Europe and the US, so they have created a Bermudan style which is kind of a mix of both. Is everyone clear about exercise style now?
Yes.
You understand what is meant by exercise style? Yes? Okay, so now, so these are the things you have to clarify as a user. Okay, you have to define all these inputs. Okay, then otherwise the dealer is not clear. And then what the dealer will also do is the dealer will enter these three okay, let's just remove the word asset now. Okay, let's just keep asset here. Asset always means market instrument combination. I want to just make it all fit in one line. Okay, so the volatility is one important input. These three inputs have to be put in by the dealer. Okay, because you will not know this, the dealer will know this information. So he will put in the volatility of the underlying asset. Okay, interest rate obviously is, these are related to all of these are related to so expiration is a key factor. Okay, over life of option means obviously related to expiration. So if you're talking about a 3-month option, okay, what is happening here? Now again I have to deduct marks from Satyam's team and Shivani's team. There's some activity going on. Now we have to open this CP sheet. So understand that. So when we talk about volatility, what is the volatility of this particular asset? That is obviously everything is with respect to the tenor of the option. Okay, whatever the expiration date, obviously the discussion of volatility is happening with respect to that period. Okay, because the volatility for a different period will be a different figure. So Satyam is in GABA's team. Where is Satyam? Yeah, GABA's team. And Achal's team is the top scorer, I think, this time. Very active. Her controls are not working. Okay. Okay. Let's go back to this. So these 3, 6, 7 and 8, 6, 7 and 8 have to be entered by the dealer. Okay. And obviously it is obvious, but I'm just mentioning it just to be clear so that you have the reiteration of the importance of the expiration date. So when we are talking about the so in future I'm just going to instead of using a big word like volatility, I'm just going to say vol. Okay, so vol means volatility. I may use 2 words. I may use H vol for historical volatility or I vol for implied volatility. Okay, but I'm just going to use vol. So vol is obviously for the tenor of the option. Similarly, interest rate is also for the tenor of the option. Okay, if you're talking about a 6-month option, we are only interested in the 6-month interest rate, not in 5-year interest rates and things like that. And expected dividends over the this is the stock market, this is a stock option terminology. The more general term would be expected, I think we should write it the other way. We should write the general category first. Expected, so I'm just going to use the word yield. Okay, so dividend is a type of yield. Do you agree?
Yes.
Okay, yield is any kind of return. So dividend is a return on an asset. Okay, where the asset is the stock. So we are going to say expected yield on, that is what we really mean. Okay, expected yield on the underlying asset. Okay, again obviously this is also pertaining to the period of the option only. Okay, everything is pertaining expected yield on underlying asset as a general expression, because dividends will only apply to stock. So we can write this in the bracket as example dividends. Okay, all right, so this is what, so these are the factors that go into the pricing of an option. Okay, is this clear? Okay, so these things, all of these things, as you see, so here I've said here, so everything is written over here, I vol, H vol. Now be careful here. Many people who are not properly trained often talking about age fall when you're expanding when you're expressing the full term. People say historic volatility. It's not historic, it's historical. You know what is the difference between historic and historical?
It's an historical.
Yes, who will explain?
Sorry.
Again, nuances of the English language, but you have to be very, very careful because you're an MBA. You're expected to be skilled in the use of language. Okay? What is the difference? Why am I so particular about the difference between historic and historical? Yes? So historical, since it's not an English class, let's not spend too much time on it. But you need to be aware of the difference, okay? Especially for vol. When we say age fall, we mean historical, not historic, okay? Historical is anything that belongs to the past. So when we stand today, we can say that all dates in the past are historical dates, okay? Historic dates are certain specific dates which have a special significance. So we can say that 26 January 1950 is a historic date for India, because that is the date on which Constitution was adopted, okay? So historic date is a special date. So a historic date is again what we use what is the language we should use? A historic date is a species of historical date. Okay? That all historic dates are historical, but all historical dates need not be historic. Will typically not be historic, because historic date is something which is a special date. Okay? Is everyone clear? Okay. So, because many times you'll find people in the markets also even using historic vol. It's not actually historic, it's historical. Okay? Alright, okay. So, these are the input parameters. If you want to get a sense of it, you can look at this option. Now, I think we should, yeah, I'm going to mention this. Another thing that we're going to see is, again, the difference between the market lingo and the and what should be the correct theoretical lingo. Okay, let's look at this here. Maybe, yeah, let's have a look at it first. Let's have a look at this. If you go here and click on this optionprice.com, this is what you will get. No, not this. That link is also there, I think. Or I'll put the link. Okay, so here's an example, but I think we have to make it much smaller. Alright, but now you can't see the figures. It doesn't matter, you don't have to see the figures. Actually, you do need to see the figures. How are we going to make it work? I can't even move this. Okay, let's just try once. But can you at least read Nimish, can you read the writing? Underlying price, theoretical price, over here. Can you read that?
Yes.
Yes, okay. Okay, so you can see here that this is an option pricing model, which the market will refer to as an option pricing model, but we will refer to as an option. I mean, you should have in your own mind, you should understand that what the market calls option pricing models, actually those are valuation models. Okay, so there's a difference between pricing and valuation model, but the market will always use option pricing model. Okay, so these are all option pricing models. These are some of the examples. If you look at this, I'll just put this also in your notes so you can tinker around. All right, now you can see these are various models. So Black-Scholes model you've heard of?
Yes.
I was told to give you some guys some idea about the models, the basic models. Okay, so maybe we should just list them as well. So actually the proper term that is, it should be Black-Scholes-Merton. Okay, because Robert Merton also contributed to the model that we used for equity option pricing. So it's actually Black-Scholes-Merton, but many people just call it Black-Scholes. Anyway, so we will list the models. But these are the various types of models. These are called option pricing models by the industry, but I'll explain to you why they should actually be called valuation models. Okay, so let's look at it here. Okay, you can see this. Is it bigger here? This is slightly bigger. The font, same thing more or less. You can see all these inputs that go into the model. You have to specify what kind of model, but that actually the dealer will decide. Okay, and then you have all the stock price here. Obviously this is meant for equity options, so this should be the underlying asset price, okay, that the dealer knows. You just have to tell him what price what market instrument combination you're looking at. He will know what the price is, okay. So you see all this stuff is put in, and I think this one has I think maybe they've got a paywall or something like that. Okay, so they have it's taking a long time to calculate. If I put this here, you can change the underlying price, okay. You can't see the value of the call option. You guys can't read at the back?
Yes, sir.
Can you read? Vibhu, can you read? 3.019. Okay. So if we just look at some of the things, if the underlying exercise price is 100, can you read the numbers?
Yes, sir.
Last bench, you can read the numbers? Okay. So exercise price is 100. Now if I change the underlying price from 100 to say 70, what will happen to the call option price?
So 100 to 70, it will increase.
The call option price will increase.
Sir, no, it will decrease.
Underlying price,
Sir, it will
actually this will take a long, this exercise maybe we should do at a later time, but we'll just play it with it once, okay. So
Sir, it will decrease.
it will decrease. Why will it decrease?
So because sir, exercise price is far away from the underlying price.
Okay, so what does that mean?
Sir,
Yeah.
sir, the price, it will take time to reach the exercise price.
Yeah, so the chances of making money on that option are much less now, because the underlying price is much lower than the exercise price.
Yes.
So if you have bought an option with the exercise price of 100 and the underlying price is at 70, then you have to wait for it to come all the way to 100, and even beyond that only then will you make some money.
Yes.
So therefore, rather than if it was already at 100, then there's a much better chance of making money, so then you're willing to pay much more for it, okay. As you can see here, if I change the underlying price to 70 and do calculate once again, notice the call option is 3 point, maybe I should just change the rounding to, okay, let's see, right now we have 3. So we just calculate once again, you see that it should go down, okay. The value of the call option essentially has gone to 0, okay. There's such a big impact that it has actually gone to 0, all right. So okay, so you can play around with this. This is also, oh, I shut this. Stop seeing this ad. Okay. All right, so you can play around with this, but this is basically it. So the point is that the dealer, these are the inputs. So we are just starting out with basics, and these are the inputs that you need to enter into the option pricing model and to get your prices, okay? All right, now let's look at this particular thing, little bit of theoretical discussion, okay? Why it should be option valuation model rather than, in the industry, we say option pricing model, okay? And so we say option pricing model, okay, of OPM. OPM is also a term that in money management, you should be aware of this also. In TAM and AM, OPM means, let's reduce this, other people's money. This is a serious expression that is used, okay? Other people's money, because many money managers start out by managing only their own money. So when you start out to, start managing other people's money, that's a different institutional framework is required. So in TAM and AM, in the world of asset management, OPM has a different meaning. Okay, here we'll just say OPM for option pricing model. And what we are saying is that the correct terminology should have been option valuation model, not option pricing model, okay? Because, why do I say that? Because pricing is basically what is called, what we have already discovered as, remember we talked about price discovery, okay? That means basically setting and resetting market price, okay, through, not writing full sentences, through the interaction of supply and demand, okay. So all right, so you remember when we discussed price discovery? You remember the expression price discovery? What is price discovery? It's one of the most important functions of markets. This is why we have a market economy. When you have a market economy, the difference is that price discovery should all be clear about. This is partly your economic theory as well. Okay, why do you have money? What is the difference between a capitalist economy and a socialist economy? Like when you had the Soviet Union, okay, what was happening in the Soviet Union? The allocation of resources was decided by the Central Planning Committee. Okay, like what we also had in India, the planning commission and all that. That was the Soviet style planning. Okay, so all the allocation of resources, how much cement is going to go to construct school buildings versus how much is going to go to construct factories, whatever, that is decided by the Central Planning Committee. Whereas in a capitalist system, you have markets. Okay, markets just have price discovery, and as price discovery, when prices go up, price discovery means prices are continuously being set and reset by the market through the interaction of supply and demand. Okay, that is what pricing is. So sometimes prices shoot up, sometimes prices fall, as you have seen. Okay, so what happens when prices shoot up? What happens to supply? As a slightly lagged response, supply will also increase. Okay, if corn prices are going up, many farmers will want to switch to planting corn. Okay, so in a capitalist, you should understand all these are all very important conceptual frameworks that you should have in your mind. What is the basic difference between socialism and capitalism? That in the resource allocation in a socialist economy is done by the Central Planning Committee. Okay, they decide how much is to be used for planting corn, how much is to be used for planting soybeans. Okay, therefore they decide everything centrally. Whereas in a market economy, in a capitalist economy, there are markets for everything, and individuals take decisions. Individual corn farmers will decide to move into planting soybeans. If soybean prices are going up much more, they will see that's a more profitable. So it is the market system, price discovery, which drives the allocation of resources. Okay, as the price of something goes up, people are enticed to supply more of that because the price is going up. Okay, and in reverse, etc. Okay, so this is very important. So this is price discovery. And so when we talk about pricing, the correct meaning of pricing really is just the setting of prices. So you don't need a model to do pricing because the market is always doing pricing. Okay, later on when you do this concept of implied eyeball, when you do eyeball, you'll understand that eyeball actually represents the meeting point of pricing and valuation. Eyeball is actually it represents a meeting point of pricing and valuation. Okay, what is happening is, what happened? Ayush, you want to score again 2 points? Okay, where do we seat you? Okay. Okay, so are you able to follow this? This is a very important discussion that we had. This is already in your notes, by the way. Okay, please make sure that, but I think most of you have become clueless about it. It's a very important point to understand the fundamental difference between the technical difference between a capitalist economy and a socialist economy. How resource allocation is done in the two economies. Because resource allocation decides everything. In our country, you'll notice that there's a lot of excess inventory of real estate. There is a lot of, if you look at the National Housing Bank comes out with information every couple of years, I think there were particular statistic that I track, which is the ready to move in housing which is not occupied. Okay, so that gives you an idea of overbuilding in the market. Ready to move in housing which is not, ideally there should be a tenant at least there, if not the owner, but there is an inventory. And I remember, I've not tracked it for a few years now, but I remember seeing for several years that figure kept on going up because there's overbuilding because of all kinds of regulatory issues and capital market risk constraint issues. Okay, because of capital control, people have nowhere else to put their money. If we had free capital, free capital markets, free capital account, a lot of that money might have gone offshore into other investments, etc. So anyway, so you can see that, you can say from a systemic point of view, this is a misallocation of resources. All that cement and concrete and steel and all that has gone into building all this housing. which nobody is occupying, ready to move in housing which nobody. So you can say from a systemic point of view, this is a misallocation of resources. All that is used up now, all that cement and stuff. You understand all this? You understand what we're talking about? Okay, these are all important things, that these are from a macroeconomic policy point of view. Okay, so we say that, so therefore pricing is not correct because you don't need a model to do pricing. Okay, what it actually is, a valuation. This is what is valuation. Valuation is essentially what we call fair value models. Okay, which you have already done. Okay, all this stuff that you have done in terms of NPV and all that. You realize these are all, you haven't heard this expression, fair value model. Have you heard this expression? Fair value model? Okay, but these are all fair value models. Okay, all this stuff that you guys have done, IRR, NPV, okay, value of a stock. Okay, the stock value, if you take the example of a stock valuation model, okay, let's say the Gordon growth model. Okay, sorry, come again?
Will it not be the book value?
No, book value is you can see what the book value is by looking at the accounts. Okay, but the point is, when you're talking about fair value models, okay, what is a fair value model? What is happening? Why here? What happened? Now Ridhima is also talking. We have to deduct marks from her team. I don't know why everybody's suddenly very switched on. These are all important concepts, and I don't think you guys have a very good understanding of these concepts. And everybody is kind of switched off. I don't know what the problem is. Is there some problem? Then you should tell me. If there is a problem, you should tell me what the problem is. Instead of, I'm not seeing people engaged with, and it's not like you are experts in all this stuff. If I ask questions, people are not able to answer at an expert level, but yet people are sort of switched off. I don't know what the game plan is. I'm not able to follow. Everybody should be looking at me and engaging with what is being discussed in the class. You guys are not experts in all this stuff. These are all important concepts. We just had a discussion about socialist versus capitalist economies. So these are all important things which you have to be aware of as an MBA student. But I don't know why people are just switched off. Lot of activity and people just switched off from the discussion. So understand this concept. These are all concepts that you're doing a course on financial modeling. You were about to do some outside course. You should have a basic. I will hopefully have some time later on to have a general theoretical discussion on model. I'm sure if I ask you now what is a model, you will not be able to give me a proper theoretical answer. Okay. So understand. Okay. Let's at least understand this concept of a fair value model. This thing, Gordon growth model, which you have done for stock valuation. This is an example of a fair value model. Okay. Fair value model, actually this requires a discussion or theoretical discussion of models, but essentially what is a fair value model? What does it do? It essentially FBM Okay, so in the Gordon growth model, what is the asset that you are valuing?
The dividend.
No.
Share price.
The share price, okay? You're valuing the common stock, okay? So we can actually, maybe we should have that small discussion on models now itself, because it will be important for us to proceed further, and you need to have this theoretical understanding, okay? So if we talk about, so the asset being valued in this case in the Gordon growth model is the common stock, okay? So you're valuing the common stock, and what are the inputs that you're using in the Gordon growth model? Dividends, okay, continuous stream of dividends, and anything else? Growth rate of dividends, okay,
Discount rate.
and the discount rate, okay. So if you take the full form of the Gordon growth model, okay, you have the R and the G and the D, okay. You have the dividends, you have the discount rate and the growth rate, okay. So so the Gordon growth model is an example of a fair value model, as is your NPV, IRR, everything. All these are fair value models, okay, which means essentially these are based on some kind of, these are actually forecast based, okay. These are forecast based models, okay. So if you see here, you take the example of the Gordon growth model, okay. let's use the words. Okay, so have to have an understanding of the Gordon growth model. Inputs are, as Goel said, what? Discount rate, dividends, okay, G is the growth rate of dividends. Okay, these are the three inputs in the model. Is that clear? Everyone agrees? Okay, I'm sure most of you have also forgotten the Gordon growth model. At least some of you remember. But Kriti's expression tells me that she has forgotten. You remember? Okay, so the three inputs in the Gordon growth model are essentially your dividends, the growth rate of dividends, and the discount rate. Okay, and what is the output here? Output is equal to the fair value of the stock. Sorry?
Input time period.
Time is not really, because you are using, that is a continuous, that is an infinite series sum, no? Essentially. So we won't take the time as an input period, as an input, okay? Because essentially, if you, in the way you write the, you guys remember, I hope that that is coming from the sum of an infinite series. A convergent. Remember, there are two types of it. You have divergent and convergent. You've forgotten all this. Infinite series, you've forgotten. Convergent, and this is a convergent infinite series. Okay, that's why there is a sum. Okay, so therefore now, so output is the fair value not of stocks but of the stock, the fair value of the common stock. Okay, so essentially what we have to understand is, now please make sure that we get this.
Fair value we can get the intrinsic value.
Okay, we're almost there, but we'll come back to this. But I think I'm going to use this.
Instead of fair value, we can use intrinsic value.
Yeah, it is the same. Fair value and intrinsic value thing, but the expression that is used in the industry is fair value models. Okay, it's a fair value model, which means essentially it's based on a forecast. Okay, it's based on the forecast that, if remember here, your dividend business is a forecast, your G is also a forecast. Dividend is a forecast. Okay, today's dividend is not a forecast. Actually, G is the forecast, because today, I mean, even one period forward is also a forecast, because you can't be sure. Okay, so the growth rate of dividends. Okay, now Ishan is very happy. We can leave on time. Okay, go. Okay, go.